Okay, so buckle up because today we are diving headfirst into some pretty big headlines.
Definitely a lot to unpack.
We're talking potential port shutdowns, whispers of a bull market, even a peek at celebrity real estate.
And it's all connected, which I think is particularly interesting.
Absolutely. And speaking of interconnected, let's start with this looming port strike.
Yeah.
It's hard to overstate how crucial these ports are to the entire U.S. economy, but what does a potential shutdown actually mean for, say, someone who's just trying to do their holiday shopping?
Well, Truist, for example, is already waving red flags about potential product shortages
Yeah.
and price hikes.
Right.
So imagine longer waits for those must-have electronics, maybe even some empty shelves as we get closer to the holidays.
Wow.
It's a ripple effect, and it hits consumers right where it hurts their wallets.
Yeah, makes those early holiday shoppers look pretty smart right now.
Yeah.
We've heard whispers that giants like Hasbro and Mattel locked in most of their holiday shipments. But what about everyone else?
That's the billion-dollar question.
Right.
The markets are definitely on edge. Wall Street's already bracing for a lower open today, and Jim Cramer's warning about a potential $4 billion daily hit to the economy if this drags on is nothing to sneeze at.
$4 billion a day? That's like wiping out the entire GDP of a small country every 24 hours.
Yeah, it's a big deal.
Can you break down what that actually looks like in real-world terms?
Well, in a nutshell, businesses start hemorrhaging revenue, consumers get slammed with higher prices, and the whole economic engine starts to sputter.
Yeah.
The longer this strike goes on, the further those ripples spread, potentially impacting everything from job growth to our overall economic outlook.
Not exactly the holiday cheer anyone was hoping for.
Right.
But here's where it gets interesting. Some analysts are saying that companies like container shipping lines are actually at a good spot to weather this.
Yeah.
How does that work?
It's counterintuitive, right?
Yeah.
But think about it this way. When you create a bottleneck in the system, like a port strike, the companies controlling the flow of goods suddenly become even more vital.
Okay.
In this case, it's the container shipping companies.
Right.
Their services are now even more essential, which often translates to higher prices and potentially even bigger profits, even if the total volume of goods shipped takes a hit.
So it's a bit of a, rising tide lifts all boats situation?
Yeah, you could say that.
At least for the shipping giants, even if it's a bit of a bumpy ride for everyone else?
In the short term, yes. But we have to remember, this is a high-wire act.
Right.
If this strike drags on and the economy takes a real hit, those gains could disappear faster than you can say supply chain disruption.
It's a high-stakes game, for sure.
For sure.
Now, let's shift gears from massive cargo ships to the world of corporate boardrooms.
Okay.
After a 15-year reign, Schwab CEO Walt Bettinger is stepping down, and Rick Wurster, a relatively new face at Schwab, is taking the reins. What's the verdict on this changing of the guard celebration or cause for concern?
It's always a big deal when a longtime CEO steps down,
Yeah.
especially someone like Bettinger, who steered Schwab through a period of immense growth and transformation. All eyes are going to be on Wurster and his track record within the company.
Yeah.
He's got some big shoes to fill, no doubt about it.
And he's stepping in at a time when the markets are, shall we say, a bit more volatile than usual.
Yeah, you could say.
Speaking of volatility, it seems even the Magic Kingdom isn't immune to a little market turbulence, with Disney facing some rough waters ahead.
Sadly, no fairy tale ending for Disney this time.
Let's go on.
Park attendance is down, and analysts are predicting some choppy waters for their stock in the coming months.
And you have to wonder if this potential port strike will only add fuel to the fire.
Oh, absolutely.
Those Mickey Mouse ears and princess dresses don't exactly magically appear on store shelves.
Exactly. Any disruption to the supply chain is the last thing Disney needs right now and could make their existing challenges even tougher to overcome.
Not the most magical time to be in the Magic Kingdom, it seems. But on the flip side, we've got NIO, the Chinese EV maker, riding high on record deliveries. Their stock is surging, proving that the electric vehicle market is still generating a lot of buzz.
NIO's success story is fascinating.
Yeah.
They're riding two major waves right now: the global shift toward electric vehicles and the emergence of Chinese automakers on the world stage.
But is this the kind of growth that's built to last, or are we headed for another EV bubble?
All right.
Remember those Nikola days?
Nah.
Investors got burned pretty badly.
That's the billion-dollar question, isn't it? The demand for EVs is definitely real, and it's growing every day.
Sure.
But the market's also getting more crowded by the minute.
Right.
For NIO and other players in this space, the name of the game is proving they can maintain this momentum over the long haul.
A high-stakes race to the top for sure.
Absolutely.
And speaking of high stakes, legendary investor Ray Dalio just dropped a bit of a bombshell saying China is facing a critical fork in the road, deal with mounting debt, or face potential economic stagnation.
Yeah. When Dalio speaks, the financial world listens.
Right.
What he's highlighting is a dilemma that's giving a lot of economies sleepless nights. How do you get a handle on skyrocketing debt without putting a stranglehold on growth?
It's a tightrope walk, that's for sure.
For sure.
And it's not just a China problem, is it? This has implications for the global economy.
Absolutely. As China stumbles, the whole world feels it.
No.
The decisions they make in the coming months will have ripple effects across the globe.
So Dalio's certainly given us a lot to think about when it comes to China's economic future. But while Dalio's sounding the alarm bells, Larry Fink, the head honcho over at BlackRock, is sending a different message entirely.
Really?
He's calling those predictions of deep rate cuts crazy and pointing to the still strong economy as proof.
Huh. Interesting. Fink's comments are a good reminder that not everyone's buying into the doom and gloom narrative.
Right.
He's clearly seeing bright spots in the economy that others might be missing.
Okay.
Whether his optimism is justified in the long run, well, that's another story.
A healthy dose of skepticism is always a good thing in the markets.
True.
Speaking of skepticism, we've got some analysts out there predicting a potential mega rally in Chinese stocks with gains of up to 100%. What do you make of that?
Let's just say I'd take those predictions with a grain of salt.
Hmm.
While there's always a chance for big gains, especially in emerging markets like China, those gains usually come with a hefty dose of risk.
So maybe not time to go all in on Chinese stocks just yet.
Probably not. It all comes down to your personal risk tolerance.
Right.
Are you comfortable with the potential for big swings in either direction?
Words to live by in the investing world, that's for sure.
For sure.
Now, before we move on to other news, let's circle back to a topic we touched on earlier, those potential ripple effects from the port strike.
Okay.
You know, Disney's not the only company that relies on a smooth-running supply chain to keep those shelves stocked.
You're absolutely right.
Right.
And this brings us to a rather intriguing case study in market psychology. Anheuser-Busch. Their Bud Light sales are still struggling after recent controversies, but some analysts are saying now's the time to buy their stock.
It seems counterintuitive, doesn't it?
It does.
Like they're betting on a comeback tour before the bands even announce a reunion.
Yeah.
What's the logic there?
It's a great example of looking beyond the headlines and focusing on the bigger picture.
Okay.
Anheuser-Busch is a massive company with a whole portfolio of brands, not just Bud Light.
Right.
These analysts are betting that the company's overall strength and potential for future growth outweigh the short-term challenges they're facing.
So a classic case of focusing on the long game rather than getting caught up in the day-to-day noise.
Exactly. It's a high-risk, high-reward strategy.
Okay.
If they're right, those who bought during the dip could see significant gains down the line. But there's also the risk that the Bud Light situation could have a bigger impact than they anticipate.
A gamble for sure, but that's the market for you.
Right.
Now, from a company potentially making a comeback to one making a risky move, let's talk about Boeing.
Okay.
The airplane giant is reportedly considering a $10 billion share issuance, and the market doesn't seem too thrilled about it.
You can't really blame the market for being a bit jittery.
Hmm.
This move has desperate times call for desperate measures written all over it.
Yeah.
The ongoing strike is hitting their bottom line hard, and this share issuance is a way for them to raise some much-needed cash to weather the storm.
But isn't issuing more shares generally seen as a bad thing?
Usually.
Doesn't it dilute the value of the shares that are already out there?
You're absolutely right. Ideally, companies would rather buy back their shares, which increases the value of the remaining ones.
Right.
But when you're staring down the barrel of a potential liquidity crisis, as Boeing seems to be, you sometimes have to make tough choices.
It's a gamble, that's for sure.
It is.
If the strike ends soon and Boeing can right the ship, this move might be seen as a stroke of genius in the long run.
Yeah.
But if things drag on...
It could magnify their problems and put them in an even deeper hole.
Wow.
It really underscores the immense pressure they're under right now.
High stakes all around.
Yeah.
Well, we've covered a lot of ground, from potential economic slowdowns to billion-dollar gambles.
We have.
But there's one more twist in this market roller coaster. We need to unpack that mysterious, obscure indicator
Oh, right.
You mentioned it earlier. Apparently, it's got some market watchers feeling pretty optimistic.
Yeah. Yes. Every good market story needs a little mystery, right?
Right.
This particular indicator, while not as well known as some of the big names, has a surprisingly good track record of predicting market moves.
And right now, what's it saying?
Without getting bogged down in the technical weeds, it essentially tracks the relationship between two key market forces.
Okay.
And right now, those forces are aligning in a way that suggests we might be in for a short-term upswing.
So a potential upswing, you say. Some might even call that a glimmer of hope amidst all the uncertainty we've been discussing.
Exactly. Sometimes all it takes is a glimmer to shift sentiment and get the market moving in a new direction.
Cautious optimism is the name of the game for sure. But you know what's always fascinating to me? Even when the markets are going haywire, you can always count on one thing to keep going strong.
What's that?
The world of luxury real estate. It seems like even when the rest of the world is hitting the panic button, the rich and famous are out there buying and selling their multi-million-dollar mansions like it's nothing.
It's a whole different world, isn't it? And speaking of that world, we have to talk about the sale of Kanye West's former Malibu mansion.
Ah, yes, the Jewel of Malibu, as it was once known. Although I hear gutted shell might be a more accurate description these days.
Right. Word on the street is that after Kanye bought the place, he decided to gut the entire thing, leaving it, well, let's just say, in need of a little TLC.
Sounds like my kind of fixer-upper.
Yep.
So who exactly was lining up to buy a gutted mansion?
An investment group, apparently. They must have seen some serious potential in the property, even in its stripped-down state.
Talk about a vision. It just goes to show that in the world of high-end real estate, it's not just about bricks and mortar. It's about speculation, future potential, and maybe just a touch of, I can turn this money pit into something amazing.
You said it. Now, while we're on the topic of bold moves in the market, there's a hedge fund manager making waves by calling this a max long moment for stocks.
Max long, is that like hedge funds speak for betting the whole farm?
Pretty much. When someone says max long, it means they're going all in. They're putting their money where their mouth is and getting big on the market going up.
So is this hedge fund manager seeing something that the rest of us are missing? Some secret formula for market success?
They're staying pretty tight-lipped about their specific strategy, just saying they have a cocktail of factors supporting their bullish stance.
Classic hedge fund mystique. Never reveal all your secrets.
Exactly. But it does make you wonder if there's more to this market story than meets the eye. Maybe something those obscure indicators are picking up on.
Always more to uncover. Well, we've covered a lot of ground today, from looming strikes to surprising stock surges, and even a little peek into the world of celebrity real estate.
Yeah, we have.
It's been a wild ride, as always.
That's the nature of the markets, isn't it? Never a dull moment.
And never a shortage of opportunities for those who know where to look. So as we wrap up this deep dive, here's something I want you to think about. Amidst all the uncertainty and conflicting signals, where do you see the potential for growth? Is it in the stability of those container shipping giants, the potential of emerging markets like China, or maybe even the allure of a fixer-upper in Malibu?
The most valuable insights often come from connecting the dots yourself and forming your own conclusions.
Couldn't have said it better myself. Thanks for joining us for another deep dive into the ever-evolving world of finance. Until next time, remember to stay curious and keep asking questions.
And never be afraid to challenge conventional wisdom. Sometimes the greatest opportunities are hiding in plain sight.